Talk about life insurance riders. If any of you have ever gone to purchase an automobile, car, in the car dealership, and you notice the advertising, let's say, says $30,000 for this particular car, you walk in, and an hour later, 2 hours later, or whatever, you walk out with a $45,000 car, and you say, well, what happened here? How could I go from $30,000 to $45,000 in a matter of an hour and a half, or something? Well, probably what happened is that $30,000 car was very, very basic coverage. In other words, basic product. Didn't have any of the enhancements that you like, for example, air conditioning, power seats, whatever, that kind of stuff. So once you're there, the dealer, of course, the salesperson will say, well, there are what they call options. Okay, so there's the option for air conditioning, or option for power seats, and all that, and so the price simply goes up and up and up. So what the car industry is really doing is they're tailoring the product basically to your specific needs and your particular budget. So if all you can afford is $30,000, then fine, you can drive away with a $30,000 car. Okay? But if you can afford some more stuff, basically, then you can basically tailor it to your particular needs. And so the end result is that the car industry has done a very good job, I might say, of balancing financial resources with the needs of the client. The life insurance industry has essentially taken a page from the car business, basically, and but we don't call them options, we call them riders. So as you can see on this board here, there's quite a number of different riders and everything else that could be added on to your basic car, you might say. So the basic car in our example is $500,000 worth, let's say, of life insurance, whole life, universal life, whatever, okay? That's your basic car. But now you want to essentially enhance the product to meet your particular needs, your specific needs and everything, and of course your budget. So let's take a look at the first one, which is a relatively new option, which they call paid-up additions, or PUA, paid-up additions. So let's say you have that $500,000 of whole life insurance, but you've also got a paid-up addition option. Well, what happens every 2 years, whatever, depending again on the company, you'll have an option basically that you can pay a lump sum amount of money, okay, at one time, take a lump sum amount of money, and that'll buy you a certain amount of insurance. So let's say, give us $5,000 and we'll insure you for $25,000 worth of coverage. Now that $5,000 is fixed and it only has to be paid once. And that $25,000 now is in fact fully paid for. So you don't have to worry about now I have to pay $5,000 every single year or something. No, it's just one lump sum, and that's the end of it. So you have these options available to you throughout the course, and you'd have to look at the contract to see when these options actually come up. But what really happens here is basically it's a lump sum payment to the insurance company, and they will then insure you for XYZ, whatever that number happens to be. Again, it's fully guaranteed. You don't have to pay another dollar for that because it is paid up, and that's the important part, is paid up. So really, what we're saying is that if you're interested in increasing your coverage over a period of time, because you know you're going to have future needs and everything else, and you will need more coverage at some point, you may want to add a paid-up addition type of option there that will allow you to buy more insurance at a future date, basically, and fully paid up. You say single premium, you might say, paid up insurance. The paid-up additions also has cash value, because remember, the base was whole life. So what you're doing is you're buying another, say, $50,000, another $30,000, whatever it is, a paid-up whole life insurance. So you will have the same privileges in terms of cash value in the policy as you would have in your base policy. So if at some point you need that extra cash and you don't want to disturb your base policy, you can actually tap into the paid-up addition portion, and it really will not basically hinder the base policy. The next one is term insurance. It'd be wonderful if your client, every one of your clients, let's say, could afford $500,000 worth of whole life. So the client says, yes, I really like this. However, it can be fairly expensive. As we all know, whole life can be fairly expensive. And there are good reasons for it, but nonetheless, it could be fairly expensive. But the client does need $500,000 for the coverage. And so how do we give them $500,000 and not necessarily all whole life and not necessarily all term insurance? In other words, it has to be $500,000 for term or $5,000 for 500,000 whole life. It could be a combination of both. So this becomes very much like a hybrid model. So for example, you could buy $100,000 worth of permanent insurance, say whole life, whatever, and $400,000 worth of term. So you have met the client's financial needs, insurance needs, okay? But the premiums have been substantially lower. So instead of buying $500,000 of whole life, which they may not be able to afford, or $500,000 of term insurance, which they say I can afford more than that, but why don't we combine the two, essentially? So we're saying is buy a base, a whole life, let's say $100,000, buy $400,000 of term insurance, and remember that the term insurance is convertible. And so therefore, as your financial situation improves over the years, you can always convert the rest of that $400,000 into permanent insurance. You don't have to convert all of it in one day. You can take $100,000 at a time, basically. Because remember, as long as you're converting within the conversion period, no medical questions are going to be asked. Okay, so as a result, it's an automatic type of situation. So you could have really a very good coverage at a reasonably good price, and then as you can afford it, you can then turn it more into permanent insurance and less into term insurance. So basically, when we're looking at term insurance, remember, it is temporary coverage. So many people will buy that for the sake of, let's say, of a mortgage, but they also have a permanent need. So a hybrid model works very, very well for those kind of clients. The next one is family coverage. And this is basically if you have, again, $500,000, your husband or wife buys $500,000, but they have a spouse, okay, and they have children. And they would like to have some kind of coverage for the spouse and some kind of coverage for the children. They don't want to necessarily spend the money to buy a separate policy because it can be fairly expensive and so on, but they would like to have something. You might say to cover at least the funeral cost or whatever, okay? So family coverage basically will cover the spouse, could be 10, 15, 20, 25,000, whatever, to say very, very small amount of coverage. And it would also cover the children, okay? So, and the children would be covered, let's say, for 5,000, maybe 10,000, whatever. But again, bear in mind that there is a 15-day waiting period for that. And so it covers all children that are born, but also children that are not born yet. So in other words, future. You don't have to go back to the insurance company every time you have a child and say, I need to change my policy. The children will automatically be insured after the 15-day waiting period. So there's that period, basically. So it really does provide coverage for the family. So the spouse, maybe the main breadwinner, we might say, is insured for $500,000, and then he wants to insure, the spouse for $25,000, and maybe all the children $5,000 each, that kind of thing there. Also, the insurance company will allow the policy to be converted on the children's policy to be converted, sometimes age 21, sometimes age 25. And again, read the contract very carefully, because some of them will say they can convert 5 times, let's say, the base that they already insured themselves for. So if they have $10,000 worth of coverage, they now can convert to $50,000. Let's say 5 times, and so that without medical evidence. So there is a conversion option which is available between age 21 and 25, basically, that they could just simply convert to permanent insurance at that point. So this is very, very good for basically a family type of situation. However, as we all know today, we also have many single parents. And so therefore, there may be a situation where there is no spouse. So in other words, all we want to do is simply buy something to insure the children, again, for funeral costs, whatever, unexpected situations and everything. So child coverage only. And once again, the same rules. They have to be born or unborn, doesn't matter, okay? They have for the unborn, there is a 15-day waiting period. And again, once again, the 21 to 25 for that conversion privilege, okay? So family coverage, spouse, children, everything. Child coverage, no spouse, simply the children. And once again, all those privileges are available to them as well. The next one is accidental death insurance, AD insurance, accidental death. And this is basic coverage that should you die of an accident, it will double the base of coverage. In other words, you've got $500,000 worth of coverage, but you bought an AD benefit, basically EDB benefit, and it will simply double. So you died of an accident, then it will be $1 million in this case. Okay, so the AD rider basically simply takes whatever it is the bottom is, multiplies it by 2 times, you might say, twice as much, and it gets paid out. Now remember that it has to be an accident. Okay, so the definition of an accident, remember, is an unforeseen event. So you're not going to be covered for suicide clause and self-inflicted injuries, things of that nature. It has to be a true accident. Okay, but basically this is very, very good coverage because it does double the base. Okay, however, cautionary note is that you must succumb to your injuries within 365 days. In other words, you have to die within that 365 days in order for that coverage. If you die after, even though it might have been caused by that same accident, you're not covered. So there is a limitation as to how long the AD rider will actually stay on after your accident. So 365 days is a crucial number to remember. The sister to that is accidental death and dismemberment. So you'll see the AD again, but you'll notice that there's an additional thing, dismemberment. So this is not really doubling your base. What this is, you're actually picking a number yourself. Say, I want $1 million worth of AD and D. So that basically means if you died of an accident, you would get $1 million. So even if you added that on as a rider to a whole life for 500,000, let's say that you had, and you died of an accident, you're still going to get your 500,000 from your base, but you're also going to get your $1 million from your AD and D. Okay? Unlike here, which basically just simply doubles it. This here is a very specific number. You choose that number, basically, and that's what you're going to be insured for. Okay? But once again, I draw your attention to this 365 days. You have to succumb to your injuries within that 365 days. Now, you'll notice that there's a D here. That's dismemberment. Every company that offers this product will have a table. And in that table, it will basically say that should you lose certain parts of your body, you're also covered. So it isn't just a death benefit, it's also a living benefit. So for example, if you lost your life, of course, it's 100% payout. But let's say you lost an arm and a leg, okay, or 2 legs, 2 arms, whatever. In other words, if you lose 2 of anything, generally speaking, it's 100% payout. If you lose 1 of anything, so you lose an arm, let's say, it'll be 50% payout. If you lose, let's say, just your fingers, there'll be a different number. So depending on that table, so you need to take a look at your particular company and say, what is it that the AD&D rider actually pays out? What percentage? So different parts of your body, so there's the different losses and everything else, will have a different number. But once again, draw your attention that if you do access this particular benefit, you must access it within 365 days. After that, it won't happen. Okay. The other thing you have to look at is again the definition of dismemberment. Some companies will say that it's an actual severance of the leg or the arm or whatever. In other words, it's gone. Some companies will say loss of use. So once again, I draw your attention. Make sure you read the document to see is it loss of use or is it an actual dismemberment. So just a cautionary note, just to be on the safe side. The next rider is guaranteed insurability benefit, a very, very popular rider. The GIB rider allows you to buy more life insurance in the future without medical evidence. So usually what happens here, younger people tend to buy these, new graduates, for example, from university, a young family thing, where we know that in the future they're going to need more insurance. It isn't going to be buy once and that's the end of it, okay? Their needs are going to be increasing over the years. And that's fine, as long as you're healthy. Every insurance company out there will be glad to insure you. But what if you're not healthy? Well, what if something happens? You have an accident, an injury, an illness, whatever it is that renders you uninsurable. How do you ensure your insurability? That's the key. So how do you ensure your insurance? How do you make sure that you can, in fact, buy more in the future? And so you buy a guaranteed insurability benefit. And that will allow you then every so often, again, depending on the company, most companies every 3 years. And so the anniversary date, you're going to get a letter from the insurance company basically saying your GIB rider option has come up. You can buy X dollars, whatever that number happens to be. Please sign right here. So in other words, there's no medical questions. So even if you were uninsurable, you could be sitting in a hospital. And still you're going to be, they can't deny you the actual coverage and everything. So it's a very, very powerful rider. All you have to do is pay the change age rate, however old you are at that time, okay? But it doesn't worry, it doesn't ask you about medical questions or anything, okay? Now this rider, generally speaking, expires around age 50 to 55, again, depending on the company. parents tend to buy this as well on their children. So, for example, the grandma, grandpa, whatever, or the parents, they buy $100,000 whole life insurance policy on their grandchildren or their children, whatever it is. But they also put in the GIB rider because they want to make sure that their child will be able to buy more insurance in the future, because obviously the child's needs are going to grow over the years, okay? And it's, again, if the child is healthy, every insurance company out there will be happy to insure it. But what if they're not healthy? And so this ensures their insurability. That's the idea of a guaranteed insurability benefit. So it's a very, very popular benefit to get, particularly, as I said, for the younger people, young families, children, things of that nature there. The next one is what they call accelerated death benefit. This is an interesting one because what happens here is that in the event, going back to our example of $500,000, in the event that you have a particular ailment, the insurance company will pay you up front before you even die. There are two situations here. The first one is terminal illness. So the doctor's giving you bad news. He's basically saying you have a limited amount of time to die. You're going to die within the next 12 months, next 16 months, whatever. Now, they're usually within 12 months to 24 months maximum. In other words, your death is imminent. It's outside of the normal mortality tables. Your death is imminent. So therefore, what happens here, on compassionate grounds more than anything else, you might say, you can actually apply to the insurance company for an advance payment to the on your $500,000, and usually they'll pay between 40 to 50% basically in advance of your death. The balance, of course, will be paid upon you actually dying. So in that terminal illness, of course, we do need proof from your doctor. So it can't be you decide I want an advance payment. It has to be proof. So your medical doctor has to send us basically part of the application, everything else. You have to send us that information saying, yes, this person is terminally ill. We expect that this person will pass away within whatever, nobody can tell, obviously, okay, but they could pass away within 12 minutes, within 24 hours. We don't know that, okay? So the point I'm getting at, okay, is that the insurance company will, in fact, pay out the amount of money in advance, and then the balance will be paid when the person actually does pass away. The next one is dreaded disease. This is very similar to critical illness. Some of you may be familiar with critical illness, okay? So this is a situation where it's not a terminal illness, but you have cancer, diabetes, heart attack, stroke, things of that nature, okay? Whereby, once again, your doctor basically said, yes, you have been diagnosed with the following, which, of course, now can cause you financial hardship and everything else. And so once again, they will advance a certain amount of money, once again, usually around 40 to 50%. But the doctor does have to give us proof that this dreaded disease is real, so it's not something that you just conjured up or something. It has to be given as proof that in actual fact there is an issue, and therefore they will once again advance payment on the debt, on that benefit, and the rest of the coverage will be paid, of course, once you pass away. The last one, which is, again, very, very popular, is waiver of premium. And this is a situation where if you became disabled and unable to perform any duties, in other words, you have no gainful occupation whatsoever, you could apply to the insurance company to waive all future premiums. Most companies will basically ask you to pay for the next 3 months. Once you put in your claim and it can be proven that, yes, you have an illness of nature that you have no gainful occupation, you pay for the next 3 months. At the end of 3 months, they notice that you still haven't recovered. Then all future payments will be, in fact, paid for by the insurance company. In other words, the future payments will be waived. So therefore, you don't have to worry about that. And they'll also refund you the 90 days that you actually paid. So you have a waiting period, you might say, of 3 months. At the end of 3 months, they notice that you're still not well. That's fine. We will now waive all future premiums, and we'll also give you back the 3 months that you shouldn't have paid, basically. And I also draw your attention to the fact that this was on a term insurance product, for example. When you convert the policy into permanent insurance, that waiver premium will still continue on. So it isn't terminated just because you convert it. It will waive the permanent insurance premiums as well. So it's a very good option to have. Now, there are 3 kinds of waiver of premiums. There is what's called personal waiver. In other words, I insure myself. I'm paying the premium, and so therefore I have a waiver premium on myself. There's also what's called parent waiver. In other words, I'm going to buy an insurance policy for my son or my daughter. I am the owner and I am the payor. I'm paying the premium and everything. And so therefore, the waiver is on my life, even though the coverage is actually on my daughter or my son. Because I'm paying the premium, obviously it makes sense that the waiver premium should be on me. Okay? And the last one is what they call payor waiver. And this is where I'm buying a policy on a third party, a partner of mine, my spouse, whatever it is. But once again, I am paying the premium. So they are the life insured, but I'm actually paying the premium. So therefore, the waiver is actually on me. And so you've got these three things: personal, parent, and payor. So that basically summarizes all the different kinds of riders that are available on life insurance. And we will see you next time.